Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
The first building block that we're going to look at are support and resistance levels. I'm actually going to go through this one a little bit quickly here to start with, and I'm going to show it to you as it relates to these other building blocks. So support and resistance levels are just very simply, they're the price zones in the market where securities liable to react in some manner that affects the trend that's in play as the support or resistance levels hit. So this means that instead of looking at a specific price, you are looking at a zone at that price. So a lot of people will use support and resistance levels. They will think of things such as previous highs, previous lows, whole numbers, that sort of thing. And they think in terms of an exact price, like a previous high might be 101.15. Well, you're not looking at that 101.15 as the exact resistance when something is coming up to test it again after it pulls back. Instead, you're looking at that zone as resistance. So even though it might be 101.15, you might have something that rallies and it only hits 101 or even 100.97 or something. It can still be in that same zone, just depending upon how other building blocks come into play in addition to these support and resistance zones. When you're thinking of support and resistance, when there's more than one type of level hitting at the same time, it's going to make it a stronger zone of support or resistance. So if you have something such as a previous high that also goes along with something, say, like a 20-period moving average. I know a lot of you guys are using moving averages or Fibonacci levels as well for trading FX. And if you have a number of these things that are coming together in the same zone, then that's going to be a stronger support or resistance level than just seeing one of these things hitting. Now, I have a number of different types of things listed here, and most of them deal with price points. So whole numbers, previous highs and lows, prior congestion zones, gap levels, such as the closure of a gap, equal or measured move support and resistance, indicator support and resistance. I'm going to show you a number of these as we look at the charts. So if some of these are things that you're not really familiar with and you haven't seen before, don't worry. I'll show you them very clearly here in just a minute. This building block here, pace or momentum, is really probably the most important determining factor when deciding not only if you're going to have a high probability setup to begin with, but how much movement you're going to be able to get out of a position, how far it's going to go, and also how quickly it's going to be able to reach those levels. So when you're looking at time frames in the options, you really need to pay attention particularly to this particular building block. And pace, a lot of people will also refer to it as momentum, but be careful because sometimes when they are talking about momentum, it's not necessarily the same thing. But it's basically a measure of the amount of time it takes for a security to establish a movement in price as compared to earlier price moves of the same amount. What this means is that if you have something that rallies, say, a point in an hour, and it then corrects and attempts another rally. If you have something that rallied that one point in an hour, but the correction where it pulls back, say, 50% of that point or 50 cents, and it takes 2 hours to do that, then you have a slowdown in pace or a slowdown in momentum. And when you have these slowdowns in momentum, these counter moves that are much more gradual than the previous move, then you have a higher probability chance of getting a strong follow-through of that previous move. So let's look at this template here, and this is going to show you some very good examples. What you can see here is that going into A, there's a very strong upside move. And when I'm trying to decide or realize, what makes this a stronger than average move? Is it the fact that on this chart it looks like it is much greater than a 45-degree angle? Or what exactly is it that qualifies this to be a stronger than average move than something else? Well, this is something you want to be very careful of. A lot of people say, well, if something is like a greater than a 45-degree angle, then it must be stronger than average. Well, what happens when you change your settings on your chart? You can squish your price action together, and then everything is going to look like a more extreme move, or you can spread them out, and it's going to look much more gradual. So don't rely upon the angle of what it looks like on your chart. Instead, go back and look at previous price moves in that particular security. So in this, you'd want to pay attention to what's going on over here, as opposed to just this rally here. So you have the rally going into A, but also pay attention to what's happening before that rally to give you an idea of what an average move. Usually when I look at things and I'm trying to decide, is something average or not, I'll look for instances where there were V highs or V lows, such as in here. And I'll look at a number of them. And generally speaking, the movements up and down of those V highs and V lows, that's going to be about an average move. So anything that is weaker than one of these V's is going to be slower than average, and anything that's stronger is going to be stronger than average. Now when you're looking at momentum here, a couple of things to think about. First of all, as the momentum begins to shift, you can see here a little pullback on C than we saw on A, then that can indicate that a trend is nearing an end, or it has a stronger probability of not going as far as it did in the past. So in this example, we had this strong rally here in A, and then another strong rally in B. But the momentum shifted with a stronger pullback here. So that increased the risk that we might not see as strong of an upside move as we saw in those previous two examples. When the momentum does shift, this is a good indication that you're starting to see trend exhaustion, where you can more easily get a reversal of that trend and a stronger counter move. For example, in this, that slightly higher high serves as a trap, and it reverses very, very quickly. When you have V highs and V lows, such as between E and I here, that's usually an indication that you're falling into a trading range. So if I see an initial V bottom, then the chances are very high that it's going to have a difficult time breaking through that previous high, and it's more likely to lead to some sort of longer trading range. Now, it might be a trading range where it does manage a slightly lower low, or it does manage a slightly higher high, or the momentum shifts and it breaks. But in either case, the general outcome is going to be a choppier, sideways type of range before that range can break. For the highest probability of which direction that trading range is going to break, look for a more gradual counter move. So in this case, we had this drop here on I, and then a more gradual pull higher on J. So that gave the higher probability of a lower break, a breakdown in K. When we're looking at setting target levels, the reason this is so important is because it can help you get into these false positions or adjust your target zones based upon how the momentum is following through. If you entered this, for example, here as a bull flag, and you saw that the momentum was following through very gradually compared to this previous rally, then you might have originally had a target up here at a resistance point that was farther away. But because of the momentum, you can go ahead and adjust your target to look for a closer level, or be more aggressive at raising your stop, whereby if this channel breaks lower in here, you can use that as a stop level as opposed to under that entire previous low from the low of C. We're going to look at some other examples here of exactly where pace comes into play with setting these target levels in a couple of the charts coming up.
Visit www.fxoptions.com